Welcome back to Investment Literacies. If you have not yet subscribed to Investment Literacies, please subscribe now to show your support. And in the past, I have talk about part one, what is money, part two, the birth of money, and today we're going to talk about evolutions of money. In continuing this series of sharings, and as volume increases, more people participate in trades and carry gold and silvers around. Some even travel far away to trade for goods that were not produced locally. However, carrying gold and silvers around is very bulky and heavy. And because of that, whenever there is a challenges, there is opportunity. So China probably is the first to issue paper money. It started by taking gold and silver deposits, and the certificates is issued to depositors. The bearer of the certificates can redeem bank gold and silver anytime. And furthermore, the certificates is transferable, and so it can be used for trade, in which new bearer of certificates could either keep the certificate redeemed for gold and silver or use it to trade. And soon, that relationships and trust is established, and people are comfortable to deposit their gold and silver and trade using certificates of deposits, and can redeem back their gold whenever they want to. And each of the deposit-taking institutions issue their own certificates of deposits and only recognize their own certificates, including those of their own branches. Today, these institutions have evolved, and as the one that we know today is called bank. So financial institutions is established based on trust, and until today, it is still very much based on trust. The government realized whoever controls the money gets to control the economy and business activities as well as tax revenues and military power. Thereafter, government agency being called central bank is set up to take over and control of money issuing and to control all the banks in the country. With that power, the government has not removed deposit-taking abilities from the bank, but have eliminated the abilities of the bank to issue notes in relation to deposits. The central bank is now issuing notes with various denomination value on it and set a fixed conversion rate to gold and silver. It is a promise to convert note into gold and silver at a specific fixed conversion rate determined by the government. And because of this fixed convertibility, it gives assurance and confidence to people to use it. And this marks another phase of money evolutions called gold standards and silver standard. It simply means notes are equal to fixed amounts of gold and silver. While the bank now act like an agent and policy executors for government, they continue to take gold and silver deposits in exchange for government notes and convert existing deposits into government notes. This relationship between bank and central banks continue until today. And central bank continue to be the only legal entity to print money and set financial policies. With this money printing power, some government go into corruptions, some into war, and some overspends. And because central bank is the only entity that can print money, so they will just print money without increasing gold and silver reserve in the world. And so whenever government print more money, it devalued its paper money, which means more money is required in exchange for some same quantity of gold and silver. So now you know that when people say in today's terms, the gold price increase, it is not the gold change in value, it is the currency that change in value. Because as mentioned in the previous videos, I've clearly stated that the gold didn't change in value, whether it is 100 years, 200 years, or 1000 years, it is still the same value. So the only changes is the currency, paper money. So soon people realized that they couldn't redeem gold and silver as premise in the gold and silver standards. It often resulted in people rushing to convert paper money into gold and silver, and subsequently the collapse of an economy and fall of many ancient empires and wiped out those paper money one after another. And because of that, the US President Herbert Hoover in 1933 in a statement have stated, "We have gold because we cannot trust government." Prior to paper money, international trade is quite straightforward because gold and silver is the same everywhere in the world. But for paper money, each country will have their own currency, and it also represents the sovereignty and powers of a country. Country A can only print country A currency and cannot print country B currency. Therefore, gold and silver standard become the fundamentals for currency exchange ratios, and each currency have a conversion rate for gold and silver. With that, paper money is taken to international trade. So when country A want to buy something from country B, A must first exchange currency A to currency B to pay for and use the currency B to pay for the B products. These transitions give birth to the international reserve, and that is to keep uh, gains in foreign currency at central bank. Currency A is not allowed to be used domestically in country B. It will affect the sovereignty and tax and military powers of a government in the country B. So do subscribe for investment literacies, and I will see you again in part 4, Money Temptations.